Australian investors should be concerned if they're invested into overcrowded, high dividend paying stocks, as they could crumble when interest rates rise, according to DNR Capital.
I just think you've got to be really careful at the moment around stocks which have benefited from low interest rates. And I'm talking infrastructure, property trusts, utilities. I think this is a segment that's had a lot of money chasing it for a long time now. Everybody's been pretty cautious since the GFC. They've been willing to chase after very defensive assets. And as interest rates have fallen, that's really supported those valuations. But if that starts to turn, then there's a lot of money that needs to move out of those assets. Stocks like Transurban, Sydney airports, we think they've got a lot of debt that's priced at very low interest rates. As interest rates start to move up, well, that starts to create a bit of a headwind for those particular stocks.
He says when interest rates rise, stocks tied to the resources and finance sectors will do well, while exporting companies like Treasury Wines will continue to benefit from the falling Australian dollar.
Stock that we like at the moment is Cube. It has recently bought the Patrick's assets. It also owns a big land bank called Moorebank, which is right next to the ports in Sydney. And there's sort of a long-term opportunity to really improve the logistics chain across Australia. A lot of M&A picking up. I think it's partly due to the fact that companies can get access to debt, but also growth prospects have been reasonably low. We've got the Tats business in our portfolio, and there's a deal potentially with Tabcorp that's certainly been announced. The other one is just those companies that are advising. So a company like Macquarie Bank is sure to be advising on a range of these transactions. That's really going to help their profit profile. So we'd expect Macquarie to do well as the M&A cycle picks up.